Welcome to opalesqueTV. Today I'm in Zurich together with Joe Taussig of Taussig Capital. Joe is one of the most accomplished experts when it comes to insurers and reinsurers who invest their assets in alternative investments. This is already our third video with Joe, and since the last video there have been a couple of important developments. So recently there has been a lot of negative commentary on hedge fund reinsurers by Warren Buffett, by S&P, and also by politicians like Hillary Clinton and Senator Wyden. So I'm asking Joe now, why is this?
Well, first of all, the inference when they use the term hedge fund reinsurers, if you have hedge fund investors who are taxable in a hedge fund, taking their money out and putting it into a reinsurance company that in turn invests in the hedge fund and turns them into non-taxable investors. And this is a complete misnomer on two levels. First of all, hedge fund investors taking their money out incur a tax on all the unrealized gains, which is often hard to make up if you invest less than 100 cent dollars. And secondly, the reinsurers do not generally invest in hedge funds. They invest in portfolios of stocks, bonds, and other financial instruments, and that portfolio happens to be managed by an asset manager. It's an SEC registered asset manager who happens to also manage hedge funds. If you want to take this to the extreme, Buffett was a hedge fund manager for 13 years. And recently people like Blackstone, BlackRock, and Goldman in the last 2 years have set up these kinds of companies. And each of them manage more hedge fund assets, if you would. I mean, Blackstone is probably the largest hedge fund manager in the world. But they have other investment strategies. We have a table that shows, we call the quote-unquote smart money. And this is about 30-odd managers that have come into the insurance and or reinsurance business. They're all SEC registered, and the investors who invest in their funds, if you would, have decided that this is probably a better investment. It has very little to do with taxation. If you look at Greenlight Re in its first 10 years, it outperformed Einhorn's offshore fund by almost 5 points per year. And it was originally funded by offshore money, not U.S. taxable money. David was the only U.S. taxable investor. In the beginning, he had to pay taxes on it because it was a PFIC. So this has to do with a better mousetrap in terms of performance. And tax, while it's nice, is a tertiary, maybe even a fourth level benefit in the process. Essentially, the list of these 32 well-known managers is color-coded. So the ones in dark blue, those are ones that are still invested, still ongoing. Those in red pulled out for whatever reason. Those in green have been acquired. Okay, so they're no longer essentially directed by an asset manager or hedge fund manager. And then there's some that have mixed colors because people like Soros and Hedge have been in more than one time, some of which are still ongoing and some of which are not ongoing or been acquired in the case of Hedge. The main point of this is that there are even more asset managers that have done this that we know that aren't on the list because they're not as well known. So arguably there's at least 70 or 80 managers over the last 20-25 years who've done this. I guess Buffett is more than 25 years old, but have done this. We also know many more that have failed than you see on this list. There's a lot of execution risk, which we'll talk about at some point in time a little bit later.
So Joe, just recap again, why are these people doing this? In other words, why are these asset managers setting up reinsurers?
Well, from the investor's perspective, it's a better return than they get if they invested directly in a fund or an SMA. If a manager can turn out 5% compounded over any 5-year period of time, so you don't worry whether you made money 1 year or 2 years and lost 3 or 4, as long as the net result is a 5% compounding, then the reinsurance company is virtually certain to outperform the funder managed account. It's that simple. Okay? If it wasn't, these investors wouldn't put their money in. Okay? That's the if you think about the way Buffett writes about it, he says we have float and there's a cost to float. In Buffett's case, the first 40 years is about 2.2%. Once he acquired Geico, he had a negative cost of float. In other words, people truly pay him to hold on to the money. But cumulatively, he didn't turn profitable until 2006 on a cumulative basis. He'd always had a cost. Think of it just like a bank deposit as a cost against a loan. So essentially, if you structure your contracts right, where your worst case scenario limits the losses to 5% per year, then if the investment returns on that float were more than 5% per year, then they add to the returns on the equity capital, and you'll beat the equity capital. It has nothing to do with tax. It has everything to do with a very good investment. Secondarily, if the company goes public, which Third Point and Greenlight have, now the investor will likely get a premium to book value. Today, neither of these trades at a premium. There's a slight discount. But that's more reflective of two things: the lousy pricing in the industry and the bad investment returns they've had for the last 2 years, 2015 and 2016. In the case of Greenlight, its first 10 years, basically it traded about 20 to 25% premium to book over 10 years period of time. So that you're not only getting a higher compounding, if you would, you apply the premium to book, and that also increases the return on investment substantially, if you would. Post-IPO, there's also daily liquidity. So you're not at any risk of gating periodic liquidity, notice periods, etc. You want out, you just sell your stock in the open market. And both Greenlight and Third Point trade $3 to $5 million worth of shares a day. So there's true liquidity there. And lastly, there is a benefit for taxable investors in the sense that there's no annual taxes on the earnings of the company nor look-through taxation to the investors. But when we did a comparison for the first 10 years in Greenlight, the difference between performance, the reinsurer and the offshore fund was about 4.7%. The onshore fund, it was close to 6%, meaning that tax was compared to higher ROEs, higher premium to book value. It was only about 28% of the difference. So higher ROEs and premium to book value were much more valuable. And the way that the Internal Revenue Service looks at abusive tax practices, if tax is the only motivation for doing it, then it's abusive. But if you get a tax benefit ancillary to a good investment decision, which is arguable since Greenlight was funded by non-US, non-taxable people when it first started, then if you get a tax benefit, that inures to your benefit. From the asset manager's perspective, they significantly increase AUM from sources otherwise unavailable. So the first is obviously premiums that you get to manage are fee-generating assets for the manager that you wouldn't get if you weren't in the insurance or reinsurance business. But that is a function of how much equity capital you have. And Third Point Re is a very, very good example of investors in a reinsurer that would never invest in Dan Loeb's fund. So starting out, there was $390 million raised from 3 private equity funds. They would never invest in a hedge fund, but they would invest in a good reinsurer that had its assets managed by a good hedge fund manager, if you would. If you look at the shareholder registers in Greenlight and Third Point, lots of mutual funds don't invest or can't invest in hedge funds. Lots of other hedge funds. Not likely to invest in a competitive hedge fund, but now they're buying a stock. Okay. Pensions and endowments are a special thing, a special situation. Pensions and endowments become taxable if they invest in a domestic fund. And many of them will invest in offshore funds because they're not taxable. But if a manager doesn't have an offshore fund, they can't get exposure to his or her talents. Or if it's small and the pension fund is an ERISA plan, it could ERISA-size the thing. So there's kind of a inability to do that. But the way this is, it's a stock. It's just like investing in Berkshire Hathaway or AIG or IBM or some other company. And then lastly, pensions, endowments, trusts, and insurance companies often have legal list restrictions, meaning that they might have investment guidelines that specifically prohibit hedge funds, or they might have investment guidelines that don't cover hedge funds, so they can't do it because whoever set it up didn't think of it. The Ford Foundation, I'm sure, does not say you can invest in hedge funds because it was set up way before there was such a thing as a hedge fund. And these are now stocks, so and then individuals don't qualify. If you want to be a $1 billion domestic hedge fund, you can only have 99 investors. The average investor is 10 million. You might have a human being with 10 million to invest, but doesn't want to put it all with one manager. When Third Point Re went public, if you had $1,250 plus your brokerage, you could buy 100 shares. So individuals. So you have a whole number of investors that cannot or will not invest in hedge funds. They're investing in this. And in our estimate in Greenlight Third Point, 80% of the assets come from sources that would never be there if you only managed a fund or managed account. Next thing is permanent capital. The lack of permanent capital impairs returns dramatically. If I'm a manager and I want to rank my ideas 1 through N, but my third or fourth one requires me to be so long, for such a long period of time, so illiquid, and I'm worried about redemption risk, I'll skip over it. So you don't necessarily get all my best ideas. If I have permanent capital, I do. Okay? The life cycle of a hedge fund manager is about 3.5 to 4 years, less than most professional athletes. And remember, back in 2002, the biggest hedge fund in the world went from peaked out of business in 1 year. That's what happens when you have a run on the bank. Permanent capital keeps you in business. There are 2 other interesting things for the manager. Fees can be deferred. Most people don't realize it, but the big fortunes made by hedge fund managers were made because they could defer their offshore fees. They have to repatriate them by 2017. So someone like Soros never had a domestic fund, so he only took what he needed, paid the taxes on it, etc., but he let everything compound pre-tax, etc., and that's so he could build a huge war chest. The TARP bill eliminated that, but oddly enough, in this type of activity, it's possible to essentially defer all the fees and take them out as capital gains. And lastly, this is probably the best way to monetize the manager is to be acquired by the reinsurance company. The IPOs of hedge fund managers have not worked well. Selling out to big financial institutions don't tend to work well, the cultural clash. And this is a way that the manager can decouple all of the ownership. There are usually multiple people, they have different places in their life cycle, etc. You look at somebody like Lee Cooperman, who's much older than most of his staff. What happens if something happened to Lee? What happens to these other guys? But if they had this and they merged it, if you would, into it, then what happens to Lee doesn't matter. It's permanent capital, the younger people can contribute, etc.
Joe, this July of 2016, there were 2 FT articles that both quoted a report by S&P that apparently said that hedge fund reinsurers are not viable businesses. What's your take on that?
Well, I would answer in a couple of ways. Investors vote with their wallets. There is more equity capital in the hedge fund business than the life and annuity, property and casualty, reinsurance, and banking industries of North America combined. Think about that. Every hedge fund investor could have invested in publicly traded financial institutions and decided not to for whatever reason. But a significant sector of the financial institution investors cannot invest in hedge funds, mutual funds. Again, back to pensions endowments having legal list restrictions, etc. So Adam Smith would say thousands of little hands making independent decisions are probably making better risk-adjusted decisions. If you buy that premise, just for argument's sake, then the real issue isn't anything but can an insurer or reinsurer that invests in alternative asset strategies outperform a fund that has the same identical investment strategy. And again, our premise is if you can earn more than 5% in the investment strategy and you can keep your cost of insurance less than 5% per year, then the answer is absolutely. So if it didn't outperform the fund with a high degree of certainty and outperform the financial institution with a high degree of certainty, there's no business. It's that simple. The second thing is S&P, oddly enough, might be a little bit sour grapes in this thing. I can't think of one of the so-called hedge fund reinsurers that has an S&P rating. They don't generally need them. The S&P ratings are credit ratings for borrowing in the credit markets, and these companies don't. They do get AM Best ratings, which are ability to pay claims. So, for example, Greenlight is rated A. Its Irish subsidiary is rated A-. But essentially, as I said, I can't think of one of that list of 32 I showed that has an S&P rating. So of course they're going to take shots at people who don't hire them for ratings. They don't take shots at people who do.
So the S&P report suggested that the hedge fund reinsurers are actually lousy underwriters and that their combined ratios were much higher than the Bermuda composite. So first of all, Joe, what are the combined ratios S&P is talking here about, and what do you say about that statement?
Unfortunately, combined ratios are a shorthand or metric as to whether or not you have an underwriting profit, but they ignore the time value of money. In other words, when you book a piece of business, you book the expected loss with total disregard as to when that loss might occur. So if it's homeowners fire insurance, it's pretty binary. You either had a fire or you didn't have a fire that year and you had the damage, we know when it is, etc. There's no long-term thing. But if it's medical malpractice, the weighted average time is 6.5 years. So if you just use a raw combined ratio and you'd say to somebody, well, it was a 103 fire insurance, but it was a 110 malpractice, you'd think the malpractice is a worse piece of business. But the cost of funding, if you would, is 3% in the fire case, and it's 1.5 or so in the medical malpractice. I'd much rather have 1.5% money for 10 years, or for 6.5 years rather, and then 3% money for 1 year. But it's a shorthand as to whether or not you have an underwriting profit or not. I can make a case that as an industry, it's virtually impossible for the reinsurance industry to have an underwriting profit as an industry. Not specific underwriters or specific reinsurers. But you think about it logically, if someone gave you $1 premium and you just put it in bank deposits, other than Switzerland, of course, which are negative, and earned a return, but you knew you would never, ever, ever, ever pay out in claims or expenses more than you had taken in, then you don't need any capital in that business, and ROEs are infinite, even with a small investment return. And if you have infinite ROEs, laws of supply and demand say you would attract competitors who would come in and discount their pricing to an extent to capture the float, invest it, and earn a spread over and above the cost of insurance. So it's very difficult to me for the industry to have combined ratios of 100 or less, meaning they never paid out more in expenses and claims than they took in premium. But they report that way. Part of the problem is that they have a lot of leeway in how they keep score. So, for example, how do you assess what the likelihood of loss is when you have many variables? Well, each time you take the variable, you take a range. The conservative person will say, well, I'll consider it this percentage, but the more liberal will say, I'll take a different percentage. And as you compound variables, the range of outcomes becomes quite large. And there is kind of a moral hazard in this business in the sense that people get paid bonuses, stock prices reflect earnings, options are all on this, and you have a lot of leeway. I mean, it's not only that you have a leeway on guesstimates of these variables, but even if you were spot on, what you can declare your reserves anywhere from 55% confidence level to 75. Some public companies do it at 55. And they're going to report a lot better earnings than the people at 75. And we're going to come back to who those people are and why, but that's perfectly legal in an accounting sense, but it sure has great implications on how you report your combined ratios. The second piece of the combined ratio I want to come up here and show on a whiteboard. So anyway, this is how the industry would look at, this is losses, the magnitude, you know, from $0 to billions, okay? And this is frequency. What percentage of the time will you have a loss of this magnitude? And the typical reinsurance company will have a curve that's something like this, with this being about the 50th percentile confidence level. And what that means, the likelihood of a loss times the magnitude of the loss has to be less than the premium you took in. And that would be this part here, okay? This fat tail part over here is Sandy, Fukushima, 9/11, etc., okay? So if you didn't have any of these, of course you look pretty good in terms of this combined ratio. I would call it, you bet against the gods and you won. Now, there's another type of underwriting that most of these alternative asset investing insurers and reinsurers, and certainly our clients do. Our curve looks like this. All right? So we have a very structured contract. We don't take hurricane, earthquake, 9/11 type risks at all, ever. We're in the frequency business. And essentially, we're not going to make very much money when things are really good, but we're not going to lose very much money when things are bad, and we're expecting to lose a little. This is back to the Buffett initially. For 40 years, his cost to float was 2.2%. But he invested it better than 2.2%. So if you had, I don't know the numbers, but if you had 2011 and 2012 in that S&P study, you'd had Fukushima and Sandy, I would submit, and those were good investment years for Greenlight and Third Point, those numbers would be substantially different. So it's the time frame you take the snapshot in. And there's some other aspects of this business that are also, if you look at Greenlight, they have cut back dramatically in their underwriting in the last couple of years. And some people have said that's a negative. I think it's a positive. For years, Buffett has applauded Ajit Jain for putting the pen away when pricing is lousy. And Ajit Jain knows he's never going to lose his job for not underwriting. But think of a classical underwriter at so many companies. It's difficult to have a job that you don't do anything when the pricing is bad. You almost feel compelled to do something to look like you're doing something or to be of value. And also, if they're going to cut people back, who's the first one to go is the person that didn't underwrite anything. So even if the pricing is lousy, and it is lousy and has been lousy, essentially you've got to be very selective. You've got to figure out how to work around that. There's an inherent moral hazard. It's not just the people trying to justify their jobs, but it's also how you, as I said, keep score. You know, if you have a bonus determined by underwriting results, but you don't know how long they're going to take, like med mal, 6.5 years weighted average resolution of the claims, or think of the World Trade Center, just resolved a couple of years ago. We all know what had happened. Most people don't realize that there was a big difference whether it was one event or two events. And I'm fond of asking people whether they think it's one or two. And whatever they say, I'll take the opposite tack, and I'll generally convince them I'm right. And then when they switch, I'll go back to their tack and convince them they were right the first time. It's a very tough thing, but these are very important aspects of the business. And it has some real issues, if you would, in how reporting is done and trying to make apples to oranges comparisons. In the life business, for example, I think the actuarial tables are 6 years wrong. Certainly at my age group they are. And that's just based on my own experience in my graduating class from university. I mean, I track the people, let them know who's alive, who's not alive, etc. And they're out by 6 years. Think about the ramifications of that. If I'm right, okay, and every pension had to reset their life expectancies, or each annuity in a life insurance company, they'd be insolvent. You know, and if you believe that biotech's going to change these numbers even more in the future, which I do, it's even a bigger problem. The life business should be great. People are going to live longer. You don't have to pay. They pay longer, and you don't have to pay a claim. But the life companies don't want it either, because if they did, they'd have to reduce the premiums, and they like these high premiums. In other words, the present value of that would be a lot lower. So you've got, again, a moral hazard in how you report and how you look at these companies, if you would. The last thing I want to talk about is confidence curves. Here, we talked about what percentage of the time this would be $100 or whatever. You start adding up a curve of this, and it creates an S-curve, which we call a confidence curve. So essentially, it looks like this. And the 50th percentile, if everything was right, that's what it should actually be reporting. Okay? But as I said, the auditors don't like this because they want a cushion. So they basically require 55 minimum. And some of them are 75%. And every insurance company can set where they want that. Think of the variation in reporting that is. Okay? And if you're getting bonuses on underwriting, and you're getting stock options and everything else, you want it at 55. You want to increase profits. But what if you didn't care about reporting profits? And I'm going to cover that in a second. Then you'd be at 75 because it reduces the taxes that you pay. We like captive insurers, for example. And a captive insurer is another form of self-insurance. Years ago, big companies would look at the checks that they wrote each year to AIG, Chubb, or whomever, and they look at their claims and said, my gosh, there's a big difference between, you know, what I paid in premiums and what I really lost. Well, of course there is. There's a lot of frictional costs. There are brokers that take out anywhere from 10 to 15%. There's double administrative handling. There's return on capital for the insurer, etc. A company like IBM could just write every loss out of petty cash, but it's better if they set up a captive insurance company and self-insure that way from both a regulatory, tax, and accounting standpoint. And obviously you don't need a broker to sell to yourself. The captive insurance company is generally managed by a human being called a risk manager. And this person is never going to have another job in that company. He's not a candidate to run sales, product development, CFO. He buys insurance. And his worst nightmare is to under-reserve in the captive. If he has to go back and ask mother for more money, he probably will lose his job. Okay, and the only way he's to get another job with somebody else. So they tend to over-reserve. They're not worried about reporting profits. Mutuals are the same way. Mutual insurance companies are owned by the policyholders. There are no stock options. It's kind of run like a quasi-governmental, agency, if you would. You don't have high pay, et cetera, et cetera. And again, they tend to over-reserve rather than under-reserve, because again, it's taxes and there's no benefit to the human being for trying to boost the numbers, if you would. Privately held companies, not so much in America, but throughout Europe. Again, privately held companies are probably pretty good candidates. And for a lot of reasons, they may not want to pour more money into the company, particularly given Solvency II. So one of the things you do is you offload some of your reserves on a highly structured basis that's beneficial to both sides. So the reinsurer lets them keep most of the underwriting profits, and the reinsurer relies on its investment strategy to take good care of the money at the time. So we tell people we rent them our balance sheet, and they rent us their cash. And as long as we return more than that cost to float, then we increase the returns over and above what you'd have in a fund or an SMA.
So at the 2015 Berkshire Hathaway meeting, Warren Buffett took a shot at the hedge fund reinsurer industry, saying that they actually just did enough business to look like they are in the industry, but that they were a sham. And he actually named Greenlight Re and Third Point Re as examples. What are your thoughts on that?
When I first heard that, I actually had to read the reportage of it to double check, and he certainly did. My first reaction is people that live in glass houses shouldn't throw stones. The irony is, if you look at Berkshire Hathaway and compare it to Greenlight Re or Third Point Re, Greenlight and Third Point Re each write more dollars of premium per dollar of equity capital and have more dollars of reserves per dollar of equity capital than Berkshire Hathaway. So it doesn't sound like they're doing just enough to get by, unless Berkshire Hathaway is doing even less to get by. This is kind of a complicated area. There are still no bright lines as to what you should be doing to be primarily in the insurance business. But when we started our business, we actually looked at what Berkshire does, and we set our numbers, our proportions, at Berkshire's numbers at that time. This is more than 10 years ago. And the reason we did it, Berkshire is taxable, so they wouldn't have a tax issue like the offshore companies have. But they have a 40 Act issue, that Berkshire would be a 40 Act if it weren't primarily in the insurance business. And that would mean that they couldn't have jumped into Geico or to Salomon to solve it if they had been a 40 Act company, and they'd be regulated like a mutual fund. This was actually raised at a recent Berkshire Hathaway meeting, and Charlie Munger brushed it aside and moved on like he didn't even want to even come close to addressing it. But the exemption language is almost identical. You must be primarily in the insurance business to be exempt from the 40 Act, or to be exempt from PFIC taxation. And so the interesting thing is the standard we set was what Berkshire was at the beginning, but subsequently Berkshire bought Burlington Northern for stock, and the denominator has grown substantially, but the numerator hasn't. So the ratios are substantially lower now for Berkshire Hathaway. And we'll come back to that in a second.
Now, Joe, let's talk about the politicians. Hillary Clinton has said that she would go after the hedge fund reinsurer tax loophole, or the so-called tax loophole, and Senator Wyden clamored for the IRS to enforce IRS Notice 2003-34 for 2 years. What are your thoughts on this?
Well, IRS Notice 2003-34 happened 13 years ago, and it highlighted that hedge funds were setting up reinsurance companies and was questioning whether or not they were entitled to take the tax position that they did. And it certainly caused, but they put out no bright lines, and they still haven't. Greenlight was formed afterwards, and we came to the conclusion, while the tax is nice, it wasn't essential. So Greenlight was originally capitalized by 100 investors, mostly out of Switzerland and the UK. Best of my knowledge, David Einhorn was the only taxable investor, and he got no benefit. It was a PFIC in the first couple of years, and he filed the election, and he paid the taxes. Essentially, what happened was there didn't seem to be any follow-up by the IRS on this. And Senator Wyden got on the IRS's case about 2 years ago, and his two targets were Paulson and Cohen. In Paulson's case, I'm not familiar with the facts to the extent I am in the Cohen situation. Cohen wasn't writing business because he was in the process with the SEC of exiting the asset management business, and didn't want to burden the company with a lot of insurance business if they wanted to sell it. And subsequently, it was sold to Two Sigma, which now manages the portfolio. The CEO is Brian Duperol, who used to be the CEO of Ace and Marsh McLennan, and Sandy Weil was the chairman of this after the buyout. So if they loaded up a lot of business at the time, they wouldn't have been able to sell it, and they knew they were going to have to sell it based on the SEC issues. In the case of Paulson, I was not familiar with it, but Validus is a catastrophic reinsurer. And in accounting for catastrophe reinsurance, you don't book any reserves until the event happens. So you're clearly, if you're covering earthquakes, hurricanes, floods, etc., you're clearly in the insurance business, but you don't have any reserves until the event happens, and you're always estimating as to what is the effect of Sandy after the fact. So Paulson didn't look like he had any insurance reserves, but it's arguable that if he had the terms of the deal were that, he wouldn't have any. It doesn't mean he wasn't really taking insurance risk. But Senator Wyden was really upset, and he started pushing on the IRS to come out with guidelines. They came out with some preliminary guidelines, but they've never finalized them. Meanwhile, my position is the IRS has been quite reasonable in this. They realize that there are a lot of complexities in the business and should try to set certain ratios, as one size fits all may not make sense, and that makes it more complicated. In frustration, last year Senator Wyden introduced a bill, and the bill essentially said that you had a safe harbor if your reserves to assets are more than 25%. You never qualify if they're less than 10%, and 10 to 25 would be facts and circumstances. Well, Greenlight and Third Point Re are way over 35 to 40, 50. In our companies, we make everybody be at least 33, and nobody goes over 66, because we also don't want the investment volatility to take out too much of the capital relative to the liabilities that are still on the table. It's interesting, the Reinsurance Industry Association is trying to get the standard lowered to 15. They have never said this, and I could be wrong. But after acquiring the Burlington Northern Railroad, Buffett's has gone down to 18. So 15 would keep him in the safe harbor, okay, for if he were offshore, but it also arguably keeps him in the safe harbor in the 40 Act.
Willis, which is the third largest insurance broker, has estimated that the like-for-like US risk pricing has eroded by 1/3 over the last 4 years. What does this now mean for your model?
Well, actually, in the severity business, it's been worse. Our estimate is it's about 75% erosion of price per unit of catastrophic risk. Essentially, the cat bond business, or the ILS in insurance-linked securities, which is kind of an offshoot of the hedge fund business, has destabilized severity pricing. So Willis has a presentation where they show Leadenhall, which is one of the large ILS fund managers, writes 25 to 30 million of premium per employee. Munich Re writes 1.5 million. Swiss Re writes 2.5 million. That's very tough for them to compete on, if you would. And consequently, and with a lack of any kind of big disasters in the last 3.5 years, its pricing is eroded dramatically. Not only is this a very business problem, but let's talk about the casualty business. When Third Point Re went public, Swiss Re had 27 times its capital and 550 times its employees. Can't be right. The casualty business is also eroded, and there's a concept I term contagion. And the analogy is 9/11. 9/11 created a malpractice insurance crisis in America. So wait a minute, what's 9/11 got to do with malpractice insurance? Well, in 2001, 35% of all malpractice in America was written by the St. Paul companies. In 2002, they wrote zero. 35% of all doctors, and you have to have coverage to practice in clinics or hospitals, had no coverage at any price. And it was a real crisis. Now, why did the St. Paul companies do this? Because the way insurance companies allocate capital lines of business, pricing for marine and aviation went through the roof, and they reallocated their malpractice capital, which is capital heavy, to marine and aviation, which is not capital heavy. And so this contagion, I think, exists now. The people that are not making profits on underwriting from the severity business are now competing hammer and tong to poach each other's business or protect their best risks in the casualty business, and you also have a price erosion there. But remember, that is the flat curve, the flat bell curve that we have. It does affect us. We have fewer opportunities, but we're still in that very high, narrow range type bell curve. And the Swiss Re's of the world would never write that kind of business because they can't take the likelihood of an underwriting loss because they can't make it up in investment returns. Could Swiss Re move into our type of model? Absolutely, but they are levered 4.7 times. So if you had a 20% drawdown, you're out of business. You know, it's zero capital, and that's what happened to Einhorn in 2008, happened again in 2015. So that's a real risky strategy. And the only way they could do it is wipe out 80% of their staff, and that'd be too hard on executive compensation to do that, to de-lever the balance sheet, if you would. Unless they could lay it off to somebody like us, and that's way too much for our type of business. Smaller insurers in Europe under Solvency II will be laying off a lot of their risks, and we're essentially alternative capital providers to them, if you would, on a highly structured basis.
So how do you deal now with this pricing problem?
First of all, we focus on businesses with far less moral hazard. So I gave you the example of captives, mutuals, family-owned businesses, if you would. And when they reinsure with us, it keeps them from having to put more capital in, which sometimes is impossible to raise. A good example is the cat bond business. The really first big cat bond, ironically, was USAA. And USAA had been my carrier when I lived in America. And I was dumbfounded because when I heard about cat bonds, I thought it was a dumb idea. But USAA took horrendous losses at Homestead Air Force Base. They had a concentration of risks. And because they're mutual, if they had a second big event in a place like Pensacola or Key West or Jacksonville or Charleston, South Carolina, where they have big military installations, they could have been out of business and no way to replenish their capital. So they bought this kind of coverage where no commercial insurer would offer it because there's too much downside risk for anybody to take a hit, but the capital markets could absorb it. And today it's about a $60 billion of risks outstanding, if you would, and it's about 20% of the business, for lack of better words. Essentially, so we focus on the less moral hazard business. We're also moving into acquiring insurers. Insurers aren't buffeted by the same foul weather, if you would, that the reinsurance business is. Reinsurance is somewhat of a commodity. People ask how we price it, and my response is the market prices it, we decide to take it or not. It's a little bit different type of business than insurance. So we bought a captive in Vermont earlier this year. We're looking to buy more. One of our clients, one of our partners bought a primary insurer in Toronto. And again, much less volatility, less likelihood of underwriting losses, etc. So you're controlling the upstream aspect of the business. And then again, Solvency II. We'll do a lot of business in Europe. Solvency II came into effect. We've never worried about it because we don't lever our balance sheets very much. And it basically is balance sheet relief for European insurers. Their only solution is to raise more capital, quit lines of business, or reinsure to somebody who will give them a fair shake on the underwriting profitability in exchange for the assets to manage. The other thing is there are 5 ways to enter the business. The first is acquisitions. The best known people that have entered via acquisition are Buffett, Exor recently. There's a high execution risk of an acquisition. The due diligence is very, very difficult to do. One time Buffett advised an aspiring reinsurance entrant to read every single word of every material contract. And what the inference is that if the word not is inserted in one line, or the word not has been taken out of one line in the contract, there's a 180-degree different meaning of that contract. And I defy anybody to take every contract, because everyone is bespoke, and search for the word not. Or search for the word not, okay, even worse. So to do due diligence in this area is extremely time consuming, and even if you did, it'd be very difficult to do. You're doing a lot of things on faith. So I don't like acquisitions. Not only is the due diligence hard, but there's tremendous moral hazard in this industry. Not that the people are necessarily bad, but the incentives are difficult to align behavior with long-term goals, if you would. The second way you enter the business is a standalone startup. That's what Greenlight and Third Point were. Again, tremendous execution risk. Several very big names in the alternative asset space have announced they're coming into the business and have not been able to raise the adequate capital or cut back. I mean, this includes people like Goldman Sachs, Blackstone, Golub, etc. The third way is something called a sidecar. A sidecar is what Highbridge has done with Arch. It's what Blackstone is doing with Axis. It's what Paulson was doing with Validus. Essentially, they're setting up a special purpose vehicle where they share the risks with the established insurance company, but the assets in the special purpose vehicle are all run by the asset manager. It's not a zero-sum game, But it's a very delicate balance between the two. All those insurance companies I named are publicly traded. Believe me, their CEO does not get up at the investor conference and say, I want you to know we have this sidecar relationship with Highbridge, Blackstone, or Paulson. But I want you to know we're giving them our very best business. That wouldn't ring too well when you yourself don't have very good investment returns. At the same time, you can't say, I want you to know we're sticking in with all our bad stuff, because that's not very good either. So it's a very complex relationship, very difficult to execute. And the last couple of attempts have raised far less capital than their targets. The fourth way to enter the business is the multi-strat platform. We put it together to reduce the execution risk. The first three almost require $500 million of startup capital. Multi-strat requires $5 million. Everything's an outsource model, etc. But it's a standalone licensed business, and we encourage our clients to bring on their own staff when they feel they can fly on their own, go to the capital markets. Three of our first six already have their own staff. One of them has already acquired a primary insurance company in Canada. And I expect at least one of those to hit the capital. One trades on NASDAQ now, and I expect another one to hit the capital markets in 2017. It's sort of like an incubator, if you would, but it still has some issues. First of all, the original premise was that we would use a prime broker who also had a bank license to issue letters of credit against the prime brokerage accounts. But the prime brokers have been moving the goalposts. And in one case, one of the big prime brokers kicked out all the small hedge fund managers, including one of our hedge fund managers. So it made getting letters of credit to secure our liabilities very, very difficult. And one of the structural problems, each one of them is a separate legal entity because it's designed to become a separate legal entity. So we are in the process of putting another one together where everybody is a cell in a single legal entity, which will make this process one heck of a lot easier. The fifth one is starting something called an enterprise risk captive. And that's where the hedge fund manager and or the private equity manager starts his own captive insurance company initially, and then takes on third-party risks over time. So it overcomes the concern that third-party risks are going to kill him, because if they're his own business's risks, like his own workers' comp, like his own business interruption, like his own cybersecurity, there's a whole bunch of risks, if you would, that they can start their own reinsurance company and graft on other business to the extent they need to do so, etc. That makes them much more comfortable.
So Joe, that was very insightful. Tell us what else is new in this space.
Well, the first thing that's new is something called enterprise risk captives. Enterprise risk captives, there are probably 6,000 to 8,000 of them in the that are owned, or the policyholders are in the U.S. They're usually small, medium-sized businesses. And we've been looking at this and said, this is a much better trade for a hedge fund manager and or a private equity manager. And essentially it's the way to enter the business, because a portion of the risk portfolio, if you would, is your own risks. So you have some control of those and you know them, rather than third-party risks, which you have no control over. Ironically, two of our clients already had these before we even became aware of it, and we are now setting up a vehicle to actively approach hedge fund managers and private equity managers to set these up. The hedge fund manager for their own business, the private equity managers for the portfolios of companies. But essentially it's a way to get into the business and get the benefits, if you would, without some of the perceived insurance risks, etc. You do have to take third-party risks on, but we have some pretty good solutions for that we think they'll find relatively palatable, if you would. And We expect a lot of activity in that. And then if they want to continue to eventually become like a Greenlight or Third Point, they can migrate from their own enterprise risk captive to the multi-strat platform to a standalone instead of having to come in at the multi-strat level.
If I would be an asset manager or a hedge fund manager, explain to me again in detail, what would be my benefit if I had an enterprise risk captive insurer?
First of all, the asset management company or the PE portfolio company gets to deduct all the premiums it pays, just like any captive insurance company. Okay? But there is no taxation on the underwriting profits, and there's no taxation on the investment returns within the captive insurance company. And you can repatriate those returns as capital gains. So essentially, it's just the same as any reinsurance company, except these are your risks rather than third-party risks. Now, if it's only your risks, you don't get the tax benefit in the captive itself. But we use a pooling mechanism so that some of the risks are yours and some of the risks are everybody else's combined, if you would, and that qualifies. So essentially, you can put a fair amount of your own capital in, and you can put a fair amount of the business, and there's no taxation. Now, that doesn't make you the next Greenlight or Third Point Re, but it gets you to cut your teeth in a way that's a lot less painful, a lot less money. And the other thing is there's no letters of credit required in this business, which is quite something, which is the tough part of the quote-unquote hedge fund reinsurers. If you want to eventually bring your own staff and migrate either to multi-strat or to something like Greenlight, it's a great way to start it.